it off with Kellogg's and a split that happened recently. What's your take on this?
Yeah, so they announced a split about a week ago that Kellogg is going to be split into three companies. And my take, and I wrote this up for the stock out, is I'm positive on it. I think it makes a lot of sense. And so if you haven't seen this, what's happening is, between now and the end of next year, Kellogg's going to be split into three companies. The current management team is going to manage the snacking business, which is sort of the crown jewel. It's about 80% of the revenue. And then the cereal business and the plant-based business are going to be spun off into separate entities. And really, the reason I think this makes a lot of sense is from an investment perspective. These various companies appeal to different investment audiences. And so the snack business is really where a lot of the value is, which was the title of my article, is really snacking is where the value is in CPG. And so, Kellogg owns a lot of just really valuable brands. So Pringles, Pop-Tarts, Cheez-Its, Rice Krispies, Nutri-Grain, RX Bar. And there's sort of this clear investment rationale where you have some growth there that's sort of mid to high single digits and should be pretty achievable. Americans are snacking more, and maybe even more compelling than that is they can take a lot of these brands and market them internationally. And there's sort of a clear roadmap for this. They did this with Pringles, where now you can get Pringles anywhere in the world, and flavors are very localized. I talked in the article about beef curry flavored Pringles they have in Taiwan. But potentially you could do that with all these other snacking brands, so people in other countries can be just as unhealthy as Americans. But it's good for your portfolio potentially, and with Kellogg trading more in line with General Mills, I think a lot of maybe investment managers sort of lump that in with cereal because sort of most know Kellogg for cereal, but it really should trade much more like Mondelez, the company that owns Oreos and just acquired Cliff Bar and owns a lot of other brands in snacking that trades about 20 times earnings. And so, I think this will be good for investors. It's sort of the snacking business will fit into this growth at a reasonable price type portfolio. The remaining businesses, I think those are different audiences. The cereal business, that's sort of a stable company. You're not necessarily going to see a lot of growth there, but it's going to pay a nice dividend, I would expect, and maybe that's for someone in more of an income portfolio. And then the plant company is for more speculative investors. Really the plant-based companies have really come under a lot of pressure in the last year. The main pure play plant company that's out there that's publicly traded is Beyond Meat, which is down 83% in the last 12 months. So I found something that's worse than, had a worse return than cryptocurrency in that period of time. It's Beyond Meat. So I think these things appeal to different audiences. I like the split. There are going to be some synergies there. You do have to have different IR departments and different accounting departments. And the company talked about it being more as focused. But I think of this as just being good from an investment perspective.
I think it's really interesting. I was reading an article the other day about how Americans have changed how they snack during the pandemic. And I think there's kind of this cyclical trend that Americans kind of go from health food to convenient health food, and then you end up back at the convenience cycle, right? Do you think that Kellogg kind of has that in their mind as well when they talk about the split and that breakup into that third entity of the specifically plant-based, because that's more on the health food side, right? And then you've got Kellogg as a whole, which is more on the convenience side. Is there any type of kind of crossover between how they're approaching the consumer now that they'll be split into three pieces?
Yeah, so certainly the health type foods, or at least those foods that are perceived to be healthy, is where a lot of the growth is, and what the brands that companies are willing to pay for. So you've seen companies like Nestle acquire a lot of the healthy brands. Those brands they can command a higher price. You even think that's part of the rationale with some of these deals that Mondelez has done with Cliff Bar, and they've done other deals too, where they've acquired companies that are more on the healthy side. So I think they recognize that at least in the U.S. we have about as much junk food as we can handle. That there's going to be this trend towards more healthy eating. In some of these markets that Rice Krispies or Pop-Tarts are sort of this untapped market. That's really where I think you'll see some more growth. So I think there's a trend towards healthier eating, but I don't think it applies to everyone. And a lot of these products that are snacking products are just be bought more as people get out more. I mean, actually, a lot of them were bought during the pandemic. That sort of habit seems to be sticking, but it seems like people are buying even more of them as they sort of get out because it's sort of food on the go.
Absolutely. And then let's talk about that Mondelez acquisition of Cliff Bar. Kind of how does this fit into their overall broader strategy? And then how does now Cliff Bar fit into their portfolio?
Yeah, so you think of Mondelez as being known for a lot of just sort of dessert type foods, confectionery items. They're most known for Oreo, Cadbury, things of that nature. But most of their recent acquisitions have been on the healthier side. I mean, they realize that there's such a large presence in that sort of unhealthy market already that if they want to expand, that's really sort of the play is to go into that direction and appeal to those consumers. And I'm sure there was a lot of competition for Cliff Bar because the valuation was pretty high, at least as multiple of revenue. It was about 3.5 times revenue. So I think that it's a valuable brand. They've done a really nice job with it, and it's part of the strategy that Mondelez has is taking that brand and increasing the distribution because Mondelez products are pretty much everywhere, and so I think you'll see Cliff Bars in more locations.
And Mike, Kaylee was mentioning trends, and one of the ones that comes to my mind was this trend of healthy food that was supposed to be healthy, but really kind of weren't as healthy as some of the other better options out there. Going forward, do you see that this could be a potential trend that could kind of rear its head again, or do you think with the separation of different divisions, some of those more healthy or plant-based options are going to try to remain a little bit more siloed?
Yeah, I think there's a debate of what is actually healthy, right? I mean, because a lot of these protein bars, bill themselves as being healthy, but a lot of nutritionists would say, well, if you want to lose weight, the first thing you should do is stop eating, protein bars. I mean, maybe if you're out on a 3-hour hike, eat some energy bars, but if you're sitting at a desk, maybe not the best thing. So, plant-based, I still think the jury is a little bit out, but it seems like the trend is consumers, at least the higher income consumers, are buying things that are at least perceived to be healthy, and at some point there almost needs to be like an audit of what actually is healthy and what is not. Maybe that's something that will come at some point. I mean, some of the smaller brands are actually putting some of the highlights of their nutrition labels on the front of the package, which is kind of interesting, just to sort of call those out, how much protein it has, the fact that there's no added sugar, those type of things that are just really sort of easy to understand. So I think that is a pretty big trend.
It's almost like greenwashing, but for health and nutrition. I can go on a tangent for days about this because it's something that I'm actually really passionate about. Mike, last question for you before we let you go. I know that we talk a lot about consumers now changing their buying habits when it comes to CPG products by shopping at kind of these wholesaler or less brand name and more, I'm losing the word for it now, but more like in-house brands instead of the brand name things. Do you think that this has any impact on Kellogg's decision to split right now? Or do you think that they're kind of seeing the opportunity of consumer will keep spending on us, the brand name, the Pop-Tarts, the Pringles?
On Kellogg's decision to split right now, I mean, Kellogg has actually performed really well during the pandemic. And actually, you go back to the last recession, they performed really well during the recession. And Kellogg's shares are up 9% year to date versus S&P that's down 18%. So there's been some nice outperformance. There's still, I haven't really seen a lot of evidence of trading down for them specifically. I mean, that may come. Some consumers are going to have no, choice but to cut back given what's happening with inflation. But that's a trend to watch too. That could impact CPG.
Mike, real quick before we let you go, you started us off telling us that you do put out a newsletter to stock out. When can we expect the next edition to come out?
So I try to get out 2 a week. So usually one on Wednesday, one on Friday. I mean, sometimes all these data issues get in the way, but try to get one out on Wednesday.
Awesome. We're looking forward to it. Mike, thanks so much for joining us this morning.
All right, we're going to take a quick break, and then we'll be right back in just a few minutes.